Test your financial literacy at our website, howmoneyworks.com/Tyrone Keys/challenge. Let's have a conversation about volatility in the markets and how that volatility can benefit you. So, what is volatility? Well, it's a measure of activity in a given financial market. It exists naturally. It's a naturally occurring phenomenon throughout all of the financial markets, be it real estate, currencies, commodities, equities like stocks. And that volatility can work in your favor depending on your investment strategy, your time horizon, the amount of time you want to remain in the markets. It can also work to your detriment based on those and other variables as well. So, if we look at a chart of the S&P 500 over the last 5 years, and remember, this is an index that measures the 500 largest companies in America. If we look at this chart, it has volatility. It has points where the market has been down. It has points where the market has been up. And it has points where it's run kind of laterally for a little while. This is, again, naturally occurring. Now, why am I bringing this up? And I'm bringing it up because of the Chicken Littles. They are people you might talk to who never have a positive thing to say about the market, but at the same time, they won't tell you what they're investing in. They'll always say, well, the market is just days away from a crash. It's going to just take it out, and it's going to be like nothing we've ever experienced. They'll say that if the market is up. If the market is down, oh, it's going to fall even further. They never have a positive word to say about the market. Now, these Chicken Littles are dangerous. And the reason they are dangerous is because if you listen to them, then you will miss out on growth in the market. And we can see at several points, let's say this point here, which was December of 2019, December 21st. Let's say we listened to the naysayers at that point and sold everything. Well, guess what? We would have missed out on growth that occurred in the following months. Or more recently, March 20th was when the markets hit their lowest point due to the recent COVID shutdowns. Well, if we listened again to the Chicken Littles, they would have had us just sell everything and put the money under the mattress. And we would have missed out on the growth that the market is experiencing currently. So, do markets rise in perpetuity? Absolutely not. You don't want them to, because then you wouldn't be able to afford to get in. So, we want the market to take dips. Should you be investing in stock? Well, let's address that. But before we do, one other thing about the Chicken Littles is when they are talking about the worst case scenario, because they do all the time. It's always the worst case scenario. When they bring up the worst case scenario, you need to ask yourself, okay, let's take an extreme example. Let's say hostile aliens land on the White House lawn and they open the door to the spaceship and they release millions of zombies. Okay. And the markets crash as a result. I can guarantee you the markets will crash if that happens. Guess what? We're not going to be worried about our stock portfolio, are we? Exactly. So there are only a few things out there to invest in. There are only a few investment classes, and I mentioned them earlier: real estate, commodities, currencies, things like that. The stock market represents a phenomenal opportunity for most people because you don't have to come to the table with a tremendous amount of money to get into it. The other markets have their advantages, like real estate. You can leverage, which is a very valuable characteristic. But should you be invested in stock? Well, that depends. You need to do your due diligence. You need to understand, based on your age, again, your time horizon, your investment strategies, what you want to accomplish. Maybe individual stocks are not for you. Now, it is sexy to say you own a share of Tesla. However, again, it just may not be for you. So let's take a quick look at some volatility here in the market. We got the S&P 500. Let's put it up against Coca-Cola and what it has done in the past 5 years. So we see a lot more volatility in that individual stock than we do in the S&P. And the beauty of this is you might be asking, well, how can I smooth my volatility out a little bit and get in on like the volatility of an index as opposed to an individual stock? Well, there are products out there that will allow you to do that. And a lot of them are coupled with the ability to have a floor, a defined floor. So you won't crash through the floor in, times of extreme downward volatility. So we can talk to you about those products. But as you can see here, Coca-Cola has been a lot more volatile as an individual stock. And just so that you have some comparison, we got a lot less volatility out of the S&P over the past 5 years, and it returned 77.48% in that time period, while Coca-Cola returned 56.2%. So you had less volatility in the S&P and a higher return over that particular time period. And if you want to stay away from the extreme detriments of volatility, then you may want to look at indexed products. This has been Tyrone Keys. Remember, you can unlock prosperity with me, Keys.